U.S. Federal Reserve policymakers have been locked into meetings this week. It's the first time they've gathered since voting to raise interest rates in June. Now, earlier, analysts said they're most likely to discuss shrinking the Fed's massive $4.2 trillion bond portfolio. Now, the Fed bought U.S. Treasuries and mortgage-backed securities in a quantitative easing program. That drove interest rates to record lows to increase borrowing and help the economy recover from the financial crisis. Fed Reserve Chair Janet Yellen is expected to issue a statement on the decision, but many analysts are not convinced there will be a third rate hike. Well, let's get more on the Fed's decision from Daniel Winges. He now joins us in Washington. Daniel, as always, welcome to the show. Now, we know the consensus was that the U.S. Fed will likely keep interest rates on hold today. What did the Fed decide?
The Fed has decided to keep interest rate, its target rate, between 1 and 1.25%, as you were saying. And also, as you were indicating just there, the Fed's statement that has just in the last few moments been released indicates that the Fed is leaning towards being slower in the pace of rate hikes going forward. Whether that means taking a rate hike off later this year from the table and not doing what it was planned is not clear yet. But I'm sure as the market begins to absorb the language in this statement, it will come to the conclusion that the likelihood of a further rate hike this year has receded somewhat.
Now, Daniel, we know Fed Chair Janet Yellen, she seemed concerned about low inflation or weak inflation during her recent testimony before Congress. Did we get a more hawkish narrative from her today?
Well, the conventional thinking from Janet Yellen over the past, year and a half or so has been this, that as the US economy recovers, you're likely to see more people in work, more people bringing out their wallets, spending more money, and therefore prices begin to bubble up. But the weird thing about this current environment is that inflation has remained stubbornly low. And so the markets, the bond buyers, and the general markets out there have concluded that what the Fed has said about the likely pace of rate hikes is not going to be what actually happens, and that in fact the Fed is going to come round to their view that inflation's going to remain fairly low, and therefore there is no case for raising rate hikes much further at the current climate. So it looks as though, from what we're reading from this statement, that that's actually the case. That for the moment, Janet Yellen's come round to the market view that yes, inflation is remaining persistently low. However, there is a proviso in there that she says she expects inflation to rise in the medium term, but certainly in the short term, she's coming round to the market view, and that points to a slower rate of rate hikes going forward.
And Daniel, were there any new details on how the Fed will unwind that $4.5 trillion balance sheet?
Well, the general consensus on this from the Fed at their previous meeting was that they would start to sell off Treasury bills at about $6 billion per month, and that every month they would increase that by $6 billion, and that mortgage-backed securities would start at $4 billion and then go up by $4 billion every 3 months until they were at caps of $30 billion and $20 billion. The question is not how they do that, but the question is when they begin. And this Fed statement suggests that they are minded to begin fairly soon. That is a very slow process. It will take a lot of time because they don't want to ruffle the markets in either the Treasury bonds or the mortgage-backed securities. So that looks like they are minded to start that pretty soon. The language is more explicit on that. So it's not entirely a dovish Fed. There are some signs that they are prepared to move. But certainly I think the markets will take away from all this that the Fed is now coming round to their view. Slow down a bit.
Now, Daniel, there's suddenly a lot going on with fiscal policy in President Trump's White House. How did that play on the monetary policy decision today?
Well, it's been baked into the thinking of economists here in Washington and across the world that the Trump White House is dealing with chaos. And in that context, it's very difficult for the US Congress to find agreement, points of agreement necessary for them, firstly, to pass a major reform, repeal and replacement of Obamacare, but then move on to the big picture for the corporations, which would be a massive set of tax reforms which could usher in a huge stimulus to the US economy. Well, earlier in the year, there was a lot of optimism that that would happen. But the Trump White House is mired in controversy. The US Congress is mired in dysfunction. And so there is a feeling out there that there is likely to be a much milder stimulus effort on the taxation front and possibly also on infrastructure spending, which would mean it would have less of a stimulative effect. I think that's all baked into the plan now. I think nobody expects it to be as great as it is, but there could be a surprise on the upside if the US Congress does suddenly become very functional, but nobody's holding up much hope of that.
Well, many thanks, Daniel, for those insights. Daniel Ringes joining us there in Washington.